Welcome to The Explainer. Today we're tackling a huge multi-billion-dollar question. How does a country like India actually pay for its green revolution? One of the most talked about answers is something called a green bond. But as you'll see, its journey has been full of promise and also some serious hurdles.
So let's start with that fundamental question. Building a sustainable future, we're talking massive solar farms, citywide clean water systems, electric transport. All of that costs an immense amount of money. So where does that cash actually come from?
Well, a key part of the answer is this really interesting financial tool, the green bond. The easiest way to think about it is like a loan, but it has one really important string attached. Every single dollar, or rupee, raised has to go directly into a project that helps the environment. No exceptions.
All right, so let's dig into how these special bonds are being put to work in India. We'll start with some of the exciting early wins before getting into the major challenges that are holding back their true potential.
First up, let's talk about the promise here, because there have been some really cool success stories at the local level that show just how powerful these bonds can be. Okay. Check this out. Let's go back to April 2021. The city of Ghaziabad did something pretty historic. It became the very first municipality in India to issue a certified green bond to raise money for a brand new sewage treatment plant.
And it worked. The bond raised 1.5 billion rupees, and that money was earmarked specifically for a project to treat wastewater so that local industries could reuse it. That's a perfect example of the circular economy right there in action.
And this is where you really start to see the potential. Just 2 months later, another city, Pimpri-Chinchwad, issued a green bond for sustainable transport, and it was a massive hit. Investors were practically lining up for this thing. It was oversubscribed more than 5 times over. It just proved that there is a huge appetite out there for these kinds of investments.
But, despite these inspiring wins at the city level, when you zoom out and look at the national picture, it becomes pretty clear that the road to a booming green bond market is, it's filled with some significant roadblocks.
And these roadblocks really boil down to 3 core challenges. We've got the missing greenium, a lack of market depth, and just plain inconsistent labeling. Let's break those down. So first up is this curious case of the missing greenium. Sounds a little technical, but it's simple. The greenium is supposed to be the financial reward for going green. It's a small discount on the interest rate that issuers get because investors are eager to fund eco-friendly projects. It's the pat on the back, financially speaking.
But here's the catch. In India, that discount has been basically non-existent. The interest rates on green bonds are almost exactly the same as they are on regular bonds. So you have to ask yourself, why would a city or a company go through all the extra paperwork and compliance costs of a green bond if there's no financial benefit? The incentive just isn't there.
Okay, problem number 2 is a lack of what's called market depth. That's really just a fancy way of asking, how easily can you sell this thing if you need to? For big investors, being able to buy and sell a bond quickly, what's known as liquidity, is absolutely critical. And for Indian green bonds, that's a big problem.
And you can literally see this lack of confidence in the numbers. Recent auctions for sovereign green bonds held by the central bank, they were seriously undersubscribed. In one auction, only 21% of the bonds that were up for grabs were actually bought. That signals a major lack of enthusiasm from the big market players.
And this all came to a head in June 2023. The RBI actually had to reject all the bids for its 30-year green bonds. Why? Because investors demanded a higher interest rate to make up for the risk of getting stuck with a bond they couldn't easily sell. It was a huge red flag for the market.
And that brings us to hurdle number 3. And honestly, this one might be the most frustrating, because it seems like it should be such an easy fix: inconsistent labeling. The problem is that many projects that are totally green in practice just aren't being officially labeled and marketed that way. The scale of this issue is just staggering. One report found that since 2015, a full 83% of the money raised by cities for green-aligned projects, things like water and sanitation, completely lacked the official green label. They were green in what they did, but not on paper, and this is just a massive missed opportunity. The same analysis found that the few municipal bonds that were properly labeled as green got a cost advantage of 50 basis points. That's a full 0.5% lower in interest costs. Issuers are literally leaving money on the table.
Okay, so we have the missing greenium, a shallow market, and some serious labeling gaps. The big question is, what's being done to fix the system and finally unlock this market's real potential?
Well, regulators are definitely stepping in. They've introduced new rules and what's called a taxonomy, which is basically a dictionary to define what actually counts as green. This helps prevent greenwashing. But as most experts agree, rules by themselves aren't enough. The market still desperately needs real financial incentives and a solid plan to get more people trading these bonds.
And this quote from one analysis really hits the nail on the head. You see, setting up the rules is a great first step, but it doesn't magically create demand. For this market to really take off, both the issuers and the investors need real, compelling financial reasons to jump in. We're talking about things like tax breaks or government guarantees.
Which leaves us with this final thought. With all these new regulations, India's created a much clearer map for its green finance journey. But, a map is pretty useless if you don't have any fuel in the tank. The big question now is whether policymakers and the market can provide the incentives and the liquidity needed to actually power the journey ahead.